Thank you, all of you, for being here today. We wanted to take a few minutes of your day today to talk about the work that the IIF has been doing on machine learning, especially in how this can relate to aiding financial inclusion. So for the last 3 years, the IIF has been looking at how our member institutions are using machine learning in areas such as credit risk and anti-money laundering. We have also done deep dives on topics such as explainability and interpretability of machine learning models, and also on topics such as bias and ethics in machine learning. Most recently, we published our recommendations to supervisors. I had the opportunity to go and talk about these results as well as our recommendations papers with US regulatory agencies, with EU supervisors, and with the Basel Committee. And the one thing that I've noticed in our conversations this year is that machine learning is no longer a buzzword. It's rather something that regulators and supervisors are well aware of. They're well aware of the benefits, and they're also better aware of the challenges and risks that this poses. Before I go into talking about what we've done on machine learning, I wanted to quickly just frame what machine learning is for those that aren't familiar with it. There is no common definition of what machine learning means, even within our membership. So rather than coming up with a concrete definition, what we've done is come up with 4 attributes that most machine learning models conform to. I'm not going to be going into the details of each one of those attributes, but I think there are 2 that are very relevant to our discussion. The first attribute is that machine learning's objective is typically to improve out-of-sample predictive performance. The second attribute that I think is also very relevant to our discussion is that it typically needs large volumes of data, and in many cases, this data is unstructured data. I also want to give you the main differences between machine learning models and the more traditional probabilistic models that many firms still use, and that is the ability to adapt to data that was previously unseen by the model. With that, I hope that the presentation makes a bit more sense to you. If there's any more deep questions and more things that you want to understand after the presentation, I'm very happy to answer any additional questions. So our first survey we published on March 2018. We had 60 firms that participated in that survey. We had a very globally diverse sample, and we still do. In our 2019 survey, we're looking at the changes that we've seen in the 18 months since we published our 2018 survey results. We have 60 firms in our sample this year again. 52 of those firms participated in our 2018 survey. We have 59 banks and 1 mortgage insurer. I think it's remarkable to show these. It shows the map of all of the firms that have participated. So you see it's very geographically diverse, but it's also a diversity in business models and in scale. There are 6 firms that participated in this study that are in the Africa and MENA region. So I think it's important to note that, given the audience. So there are 7 key takeaways that I want you to know from this presentation. So the first one, and I think it's truly remarkable, is that if we compare our results from 2018 to our results this year, we've seen a 49% increase in the number of financial institutions that have been using machine learning either in production or experimenting with active pilot projects. So if you really think about it, 18 months is not that long of time for this very dramatic change. And one thing that I want to point here that I think it's very important to note is that the conversations that financial institutions are having with us about machine learning are no longer about should we be using machine learning, but are more about when and how they're going to be using machine learning. And that trend is not only in the EU or in the US, but it's across our entire sample of banks. The second point that I want to make here is that even though retail continues to be the area where financial institutions start using machine learning. And again, this makes sense because this is where most of the high quality structured data exist. We have seen a very dramatic increase on the number of financial institutions using machine learning for SME portfolios. So in 2018, we had 8% of firms that reported using machine learning in this area. This year, we had 40% of firms that reporting using machine learning in this area. 14 of those are already in production. Have also been significant pilot projects that have gotten started for corporate portfolios. So linked to these increased usage in SMEs is the increased usage on credit monitoring. And we heard from our host earlier today talking about credit monitoring, including early warning systems. And this is reflected in our results this year. There has been a shift away from using machine learning for the more traditional regulatory areas, such as regulatory capital, economic capital, provisioning, to areas such as credit monitoring, including early warning systems and collections and restructuring. So this has been not mandated by a supervisor or regulator, that shift. It has been a strategic decision taken by the firm. So also linked to SMEs and to credit monitoring is the increased use of machine learning for natural language processing. So using natural language processing as one of the techniques that has really jumped up on how it's being used in the last 18 months. And it's being used together with supervised machine learning. So I wanted to quickly give you a glimpse on the benefits and the challenges. So in terms of benefits, I wouldn't say that there is any benefit that really has dramatically changed in the last 18 months that we did the survey. The way I view it is that the benefits of machine learning are more well known. People understand that they gain increased model accuracy. They know that they will be getting more efficiency in the model development process, which, by the way, that was the one that was chosen the most for the MENA and Africa region. And discovery of new risk segments and patterns that were previously unknown. So those are more solidified now. People are just very well aware of these benefits. What is interesting is to talk about the challenges and how those have changed in the last 18 months. So as you can see on the graph, supervisory understanding or consent to use new processes was selected by 80% of the sample. That's a 433% increase in the last year. And I will touch on that when I talk about the next slide. The second most chosen one, not surprisingly, was difficulty of explaining processes. So the whole issue about explainability, interpretability of these models, the black box, the so-called black box. I'm not surprised, and I don't think anyone is really surprised to see the difficulty in explaining processes as a hurdle. But what is remarkable is that even though these two ranked high in our survey, it is really IT infrastructure related problems and the availability of appropriately skilled staff, which firms reported being the most impactful challenges as they start applying machine learning. So yes, supervisory understanding and difficulty of explaining processes ranks high, but these are seen as hurdles that can be overcome. The issues related to IT infrastructure are also very well related to data quality issues. Data quality issues are what ranked #1 in this region. And I mean, that is understandable. That comes with the mergers and acquisitions, the various data sources that exist and the silos of data that exist. The availability of appropriately skilled staff also was something very impactful. And it's more of an issue in this region as well as Europe than it is in the US, for instance. And it's actually interesting. There was one US executive that pointed out how finding someone that knows machine learning, finance, and coding is like finding a unicorn. But that is actually felt not just by our member institutions. That is something of a sentiment that is shared by regulators and supervisors when we meet with them. They say things like, well, you know, if you think it's hard for a bank to recruit someone with these skills, then it's even harder for a supervisor to recruit these type of people. on the challenges, I thought I had an extra slide here, but on the supervisory understanding, we had another chart that showed that there was a 54% increase on the number of firms that have engaged their supervisor on their use of machine learning. So I link this increase on the supervisory understanding as a challenge to two things. The first one is that there has been a very significant increase on the number of firms that are speaking to their supervisor about their use of machine learning in credit risk. There's also an increase on the number of firms that are now using machine learning in comparison with 2018. So, I mean, simply there's just more firms that are now using this technology than they were before. But the second one is that we have also seen an increase on upscaling by supervisors and regulators about machine learning. They're better able to ask scrutinizing questions, they're better able to ask the right questions about these models. So even though it shows as a challenge here, I would actually consider these, and I think our members consider these to be something that is positive, because all of them agree they much rather have a regulator or supervisor asking them those questions than just say no because they don't understand the technology. So with that, I hope that you found these 7 key takeaways useful to you. What I want to do now is welcome my former colleague Bart van Liebergen to the stage. Bart has been one of the lead authors of our 2018 machine learning reporting credit risk when he was at the IIF. And now he's a strategy officer at FMO. So please welcome Bart to the stage. Thanks. So thank you for being here with us today. You have a very unique perspective on machine learning. Your perspective from being at the IIF, where you were able to analyze all of those 60 firms, different practices and techniques for machine learning, and now with FMO as a strategy officer. So perhaps we can start out, for those unfamiliar with FMO, talking about what FMO does and how it's related to financial inclusion.
So for those who didn't hear me, FMO is a development bank from the Netherlands. We support the Sustainable Development Goals through our financing and additional services. So we are active internationally, mostly in Africa, the European neighborhood, Asia. And what we do is we provide financing, so equity, debt, to our clients, with particularly with the goal of supporting climate action and financial inclusion. So on the financial inclusion side, what we do is we fund a lot of partner banks in emerging markets with the aim of them on-lending the funds to, in microloans, in small SMEs, etc. That's one part, and increasingly we are financing fintechs also in those emerging markets. Fintechs that have new business models that may reach customers that were previously unserved in the many ways that we've already heard today as well. So that's basically what we do.
So what are you doing particularly with machine learning?
So with machine learning, we do a couple of things. So the most important thing is that what we did is with our partner financial institutions is that we set up a program to connect them to a broader environment of fintechs and help them get them ready for the digital revolution and using new technologies. That's one thing that we're working on. A second thing is that we have also been using machine learning ourselves. The interesting thing is that when we worked in those partnerships with our client banks, we noted the challenges of banks that banks typically have in using these new technologies. There are challenges with data issues, and the IT architecture, and what we noticed is that we thought we need to start using these techniques ourselves as well to get a better understanding of what the benefits are, the challenges. So one thing that we are doing is we are working with a think tank in The Hague to map country risks so that we can get insight into the risks in the different countries that we work in internationally. And the interesting thing is that those country risks have, for a long time, this has been very much a qualitative exercise. There's not a lot of, quantitative data around this. But increasingly, there are new data sources through which you can measure country risk as well. So, for example, what we're doing now is we are working, or experimenting, I should say, with a deep learning algorithm that extracts information from news media all around the world. This is actually based on a Google source, GDELT. And this is real-time information from all around the world about news, etc. And what you can do with natural language processing, you can extract information about political developments, country developments from that news media, and then get that into a political risk variable.
That's really interesting. So you touched already on some of the challenges, and I was mentioning the two most impactful challenges was talent and then IT infrastructure. So I really wanted you to get a little bit more in the detail of the challenges that you have seen, and maybe you can touch on data and IT infrastructure in your answer.
Yeah, sure. So I think there's a number of key challenges that we see particularly. I think the first is definitely data architecture, IT architectures. I think if you look at the banking sector, many banks are, to be honest, they have a patchwork of IT systems across different banking functions because they merged with a bank and then spun off part of a bank. And so what you have in the end is this kind of big patchwork of IT systems that are barely held together by a BIOS system. So it's really hard to change that and to improve that. And that is a bad basis to start from to implement new technologies, when you need cloud-based machine learning, etc. So that's one thing. Data quality is a second one. It's just because of these IT systems, it's hard to reconcile data, it's hard to centralize it, and that of course makes it hard to use it for techniques like machine learning. I think one thing we particularly recognize at FMO is data volumes as well. We are a development bank that invests in entrepreneurs. We have around 700 clients in the world, and that's of course not very much when you compare that to the typical commercial bank. So in terms of the breadth and the depth of the data that we have, it's just limited, and I don't think it's it's not a surprise to see that if you look at where machine learning was used initially and still is used, I think most intensively is by several very large American banks. I remember one bank that has in the US that told us when I was at the IIF that they had 50 million credit card applications each year, and they used a whole set of algorithms to mine that data. And of course, with 50 million observations, then you are talking the volumes that you need for machine learning. And of course, what we're seeing in the market is that you increasingly get machine learning techniques that are more applicable to smaller data sets, and we get better and better at that. But more data is always better, and that's something I think that is kind of a natural law in machine learning.
So how are the challenges that you described different for the partnerships that you have at FMO, and then internally at FMO with your own issues?
So how are they different? So I think we recognize them. As I said, the data volumes is a point that we really see. The data quality is also is an issue at the partner banks. Also for us as FMO, you just have a how do you say a heritage that you have to work with.
So perhaps what is being done at FMO to fix some of the IT infrastructure issues?
So you have a number of things. So we are busy upgrading our IT infrastructure, and that is something that is of course a very lengthy process and involves a lot of stakeholders. And progress is incremental there, but we're getting there. On the data, I must say that regulation is often seen as an obstacle to using things like machine learning in the banking sector. In some ways, it's also an enabler sometimes. At FMO, we are currently busy with our KYC remediation, and this is really a big kind of impetus for our organization to get your data quality in order, to make sure that you get everything, centralized, aggregated in one database, which in turn is of course an enabler for better analytics of that data. So so that's something that we do. Let me see if I have any others. I think that's about it. Yeah.
So you touch on the regulatory as a positive, right? And you saw the results on our survey. And this morning we heard from the keynote remarks of Ms. Amani from the African Union Commission, and she touched on this important trade-off between innovation moving rapidly and regulation moving slowly as they identify the risk and they're better able to understand these. So what are your views on how this regulatory framework interlinks with complexity of the new technologies? And I know this is something that you also touched a little bit when you were working at the IF, so maybe you can bring in some of your experience there.
I mean, yeah, complexity and explainability, I think, is the key issue that is often discussed around machine learning. And the algorithms are, have, how do you say, great predictability, predictive power, but it comes at the cost of the interpretability of the algorithms. You're using a lot of different variables. The algorithms are highly complex themselves, so they're non-parametric, non-linear, etc., which allows them to fit the data very neatly. You get great detailed predictions, but they are hardly interpretable. And that's something that we also noted at FMO when we were working on our country risk project. So, we had these algorithms, they produce all this data, and then they rank the countries in a certain way. And then you're looking at them, and some of them, you just look at and think, hey, that's not intuitive, or doesn't fit my intuition. So what explains the score of this or that country? And basically you don't know, because you cannot look in the algorithm. There are 1,500 variables in there. You cannot look in there and to see, just why is it predicting X or Y.
So what tools will you use to, or do you use to then be able to identify?
So with this one, fortunately, what you can do is you can run, as they call, partial dependency plots. So what you do is you can test the significance of each of the input variables to the outcome variable, and then take the most significant variables and put them in a much more how do you say explainable model, a surrogate model, as you would call it. And that way you get you get more interpretability. You can explain why a certain change happens in the output variable. And that's what we're currently working on. I haven't seen the results yet, but of course, the good thing about it is that you get, you keep your deep learning model, at the same time you add some interpretability to it. So that's one way that we're working with, this is not so much the regulation, but this is also our own comfort with the outcomes from machine learning. I don't want to tell my CEO that country risk in country Y is 30 when I have no idea what's behind that. So that gives some comfort, and of course for the regulator it's good too. I think from the regulator's perspective, one thing that I thought was interesting that we saw at the IAF is, in the regulatory world you have kind of two thoughts. When we talk to OSFI, the Canadian regulator, they have a kind of principles-based approach. So what they're saying is, if you have a certain model, and it doesn't matter if it's very complex, if I cannot exactly understand what's happening in the model, but if you can defend to me the choices, the methodological choices that you made in developing the model, and if you can show me how you did this, retrace what you did, then that gives me comfort. And that's different than, for example, in the US, I think the Federal Reserve has a more parsimony of the variables approach, where the amount of variables in a model is limited by the regulation because they want to have insight in the model. You want to be able to understand exactly what's happening in a model. And so for machine learning to work in a regulatory environment, I think, you know, for regulators, they should think about, can a principles-based approach work for us? An approach where we understand the method, not as much as the model itself.
Yeah, I find that, I mean, I agree with everything you said. It's interesting because in the last year, we've seen a lot of developments with regulators and supervisors looking in more detail at explainability. So the Bank of England published their own paper on explainability of machine learning models, which I found very interesting because it touched on the stakeholders, like the different stakeholders that need interpretability or explainability and how that varies. Because you have it internally in the bank, there are certain people that are looking at the models at different stages, but then there's also different regulators and supervisors, and the needs for each of them also changes. We've also done a paper that touches on these, that sort of does a deep dive on these at the IF, and that is available on our website if anyone is interested to look at it. I don't want you all to just leave feeling about, you know, machine learning and the challenges, so I think it would be great if we touch about the benefits now. So let's talk about the benefits of machine learning, and from your own experience, you know, both at the IF and the FMO, how do you think machine learning can be useful for financial inclusion?
I think in a number of ways. Of course, there's the mining of existing data sources. What machine learning can add there is increased insight into your client portfolio and the risks there. So because you've always been using a linear, more simpler approach, a machine learning algorithm can show you those pockets of risk that you previously either you didn't identify. So it can be on the upside where you can now see some risk pockets that you perhaps don't want to lend to. On the other hand, and that's where the financial inclusion part comes in, you may be able to map those client segments that previously with simpler models you would assess as, you know, too risky to lend to, too high PD, LGD. With machine learning, you can better assess their risk, and maybe you may decide that you can actually lend to them. So it's a commercial advantage in that sense. The really exciting opportunity in financial inclusion is in the additional data sources, so new data sources. So can you use machine learning to mine all kinds of new data sources that have been coming up over the last couple of years, and where you can bank the previously unbanked, you know, the people that don't have the data that you need to make a credit assessment. And one interesting example from the FMO portfolio is, we've been investing in an Indian company called NeoGrowth. What they do is they lend to small merchants in India, and typically they're unable to borrow from a bank. They have no financial statements, no credit history, no credit rating. They typically have no assets as collateral. So, you know, how are you going to lend to them? What NeoGrowth does, it gives them a point of sale terminal, and with that you can monitor the sales of such a merchant. And based on the cash flows, you can make a risk assessment, and you can see if you want to lend to this merchant. The interesting thing also is that what it does, it can, by analyzing the data, you can actually tailor the interest payments to specific periods in the year that work well for a client or not. So you can tailor it to, when revenues are largest, interest payments will increase then, and when the merchant has a tougher period, you can decrease the interest payments again. So that's a big thing, I think, in financial inclusion. Maybe just to mention a last one. One that I haven't seen materialize so much yet, but in time, I think machine learning could also lead to cost reductions at financial institutions through automation of lending. And if you bring the costs down, of course, the consumer becomes more easily profitable, so to say. So that could also make your lending more inclusive. The thing is that so far, I think the biggest advantages of fintech lenders over banks have been automation of processes, not so much as using machine learning. So it's more about the automation of the whole lending process. And then typically what you see is the bottom 30% and the top 30% of customers you can assess automatically. You know, the top 30 is, that's a no-brainer, you can lend to them. The bottom 30 is too risky. It's the 40% in between where you don't know, you know, where you need to, up to this moment, often you need to make a manual assessment. And in time, you would hope that, you know, machine learning would help there.
So it looks like we ran out of time, but I just quickly want to ask you, we had a really great panel on the culture of innovation. So I know FMO is also, has an innovation initiative for new technological developments. Do you quickly want to talk about that?
Sure, yeah. So innovation at FMO is something, I think we've always been pretty innovative, but in a way that you see in the financial sector in general. 80% of innovation in the financial sector is traditionally located in product development. You know, we are very good at developing new products, derivatives, hedging constructions, whatsoever, but we're less good at developing new business models. And that's, of course, where fintech saw a great opportunity and came in with new business models. And that is something also as a bank, as FMO, we need to ask ourselves those more fundamental questions of what is our strategy, what is our business model. In particular for us, you know, our strategy as a development bank, we increasingly see other lenders come into our space. There's a low yield environment, high liquidity in markets. There's a lot of competition, so you need to reassess. You know, what is it? Where is additionality for an investment or a development bank like FMO, and that's where our innovation program comes in, and you know, should drive us to rethink those fundamental questions about our business. And so we'll see what comes out of that in a couple of years. So.
Well, thank you, Bart, for joining us today. I really think we had a great conversation, and I hope the audience also found it useful. Thank you.
Thanks.